Peace be upon you all. As a way of introduction, this is Amal Al-Rashid, a junior researcher at King Faisal Center for Research in Islamic Studies, and the Task Force number 8 on International Financial Architecture Coordinator. So every journey has to end, and we're so glad to end this journey successfully. We've published 8 policy briefs for Task Force number 8, and we are glad to share it with you so you can read it actually on our Saudi T20 website. I want to thank everyone who's joining us today for their time and contribution, and we are actually going to start with Dr. Nabil, the lead co-chair of Task Force number 8 and the CEO of Tasnif, to give his welcome remarks. So the floor is yours, Dr. Nabil.
Good afternoon, all of you. Thank you for being with us today. I'm very glad to be with such a team. I would like to start my remark today by sincere appreciation for Kaspark for their efforts for almost 1 year now, or more than 1 year, for preparing for having a very interesting task force through the T20. And I think they done very great job. And I sincerely, I was enjoying it. And I benefit a lot myself from leading such a task force with other colleagues who are leading the other task force. At the same time, also our task force, which is International Financial Architect, is basically very dynamic those days. Having the pandemic issue that happening early this year show that this very important subject is really revolving for a few years back. However, with this pandemic, we see there is a lot of needs for strong moves and strong regulations that really consider all these development that's coming together. The issue of pandemic and the tragedy that we went through, and we still have it. Hopefully, not to see the second wave as we are hearing from everywhere around the world. Plus the technology change that happening dramatically in the last few years in this industry in particular, through many angles and layers. The other factor basically is the needs that basically become more demanding in different way than we used before. The conventional way of dealing with financial is over, and I think there is a new way of happening. And I think also the main things that might be linked to what we're going to have today from Glev is a lot of things happening since the financial crisis in 2007, 2008. And what we living today is an basically accumulative efforts that was happening in the last few years, almost a decade now. That shows, yes, we have now a very good infrastructure that make us or lead us to a very interesting subject that need to be tackled and taking up to the leader of the G20 to basically seriously consider and also make a progress in many different directions. I would say the most important direction that we dealt with, which is also, as we said, it's linked to the COVID-19 crisis, is the monetary policy that we basically feel there is a serious need now to consider with all the closing of business and the struggling that we are facing all over the world. I think this is a very remarkable year that every monetary policy leaders is really seeing it. There is a need for serious change that move from conventional way of regulating the monetary to a different way. The other things I think related to the regulation overall in the finance industry worldwide is a serious need to deal with the digital that we are living today with. Actually, the digital life today is more advanced than even the regulator. And we should see a serious reaction from the regulator all around the world to deal with such advanced digitalization that we are living with in different way, in currencies, in fintechs, in different things that happening, and the risk is become more and more complex And the regulator is not purely financial regulator. He's a financial regulator. He's also dealing with technology, and he needs to make sure they understand those technology that basically integrated with the financial industry and dealing with so many innovative way of fintech and dealing with. The other issue, which is basically show through the pandemics, is basically, and I think yesterday the G20 financial minister and governors was clearly handling it, is the gap that we are living with different countries, like some countries in Africa and different places, and they need more commitment, more integration for the financial system that helping the less developed countries to basically come and we have the platforms like technology, as I mentioned, that make it more easy for us. And for this task force, we dealt with so many different issues, but we try to also be very focused. And we almost cover 8 subjects as of today. And I think the final subject that we dealt with, and I don't want to take much time, but also one of the major study that we dealt with is the what they call it financial safety net globally. And I think G20 is doing great jobs for years now, but also what we live with the pandemic is showing there is more need to have more safety net around the world. Nobody can be safe if the other do not cooperate with each other to help everyone to move forward. This is the whole world becomes small village now and getting smaller and smaller, and everything's happening everywhere will affect the other sides around the world. Those subjects, is, even though it shows that they are somehow linked and integrated with each other, however, when you read those policies that we developed with the authors, who we really appreciate their efforts on the last year, and I think they've done a great jobs. And also, I'm sorry for the one that we were not able to select them, and we end up having only 8 policies that we will be communicated to the T20 leaders, Caspex, to handle it or include it somewhere in the communique. That's all for me. I would like again to thank all of you, and I think this is a moment where we conclude our efforts for a year or so, and I would start basically introducing a very close friend, Stefano Wolf, who I worked with him for almost 6 years as a board member of the Glyph, and he was the CEO appointed at that time. Just to give you a very quick background, Glyph is a global legal entity identifier foundation. It's been established after the financial crisis in 2007, 2008. We started our operation in 2014. And I think this is one of the main solutions that was provided as a result of the financial crisis. And we're expecting to see a lot of Glyph in the coming years. I don't want to say more than this. I would like to welcome my friend Steven to basically give us outlook and some introduction to Glyph and how we're going to see Glyph helping the whole economy in the coming years. Welcome, Steven.
You are muted. Sorry.
Sorry for that. Thank you, Nabil, again for this very kind introduction, and welcome to everyone from my side as well. I'm very grateful that I have the opportunity today to update you on the development of the global LAI system. This is an important group, and I think there will be hopefully lots of things that we can discuss and can do together. I've prepared a very small presentation for you, which I'm going to show you now. Can you see my screen?
Yes, go ahead.
Okay. Are you moving the slides? Sorry, I was trying to pull it myself. Anyway, who is the Global Legal Entity Identifier Foundation? It's a Swiss foundation. Switzerland was chosen deliberately in order to stay completely independent from any political or economical bloc in the world. The foundation was inaugurated in 2014. Founding member was the FSB, and it is our duty to fulfill all the roles and all the duties of what was envisioned as the central operating unit back then. The LEI issuance itself is organized through the LEI issuing organizations. We have currently 36 of them, and the number is growing. And altogether, we have over 1.7 million LEIs, and I will explain in a short while where they come from. It's very important to mention that the organization is overseen by a LEI Regulatory Oversight Committee, or short LEI ROC, consisting of 71 regulators and 19 observers. And what I would like to say is that over the past years, we have developed fantastic relationships to the regulatory side as well as to the private sector side. And in many cases, we can bridge and moderate discussions when it comes to the LEI system with great success. On the next page, you will see the current distribution. It is no surprise that Europe is leading at the moment. There was a major initiative after the initial, derivatives market rollout. There was a major initiative to capture basically all issuers of financial instruments and all traders of financial instruments. And the MiFID/MiFIR regulation come into play in 2017-18, and we saw a big surge in LEI numbers back then. However, we have other growth nations. At the moment, for instance, the two biggest growth countries in our world are China and India. So we see now that around the world, the LEI system has been picked up. And we see a lot of development, a lot of movement in all sides of the world. I'm very happy to let you know that we're going to run a special program for Africa. And this will be sponsored by a development aid organization. So we hope that we can fill those gray spots with LEIs also shortly. On the next page, you see where the regulatory mandates come from. As I said, the vast majority from the United States and Europe. That's where the financial crisis originated from. But as you can see, you have several other countries with regulation already in place. And it has left the area of securities and security markets and has entered into other territories. Let me give you just two examples. In India, any credit borrower must have an LEI when the credit is over a certain threshold. Or in China, there is a law in place that for 29 countries, mostly developing countries, the LEI must be used for import-export declarations. So you see the LEI system is moving to become a more broader public good, spanning all kinds of use cases in all kinds of industries. On the next page, could you please flip to the next page? Thank you. We wanted to give you one example out of many other examples of a fantastic, relationship with the regulatory world. We've chosen the UK and the Bank of England because they have been very forthcoming with ideas on how to incorporate the LEI in payment messages. And that marks a real change for the global LEI system. So far, the LEI was not considered in payment messages, but with the upcoming ISO 20022 standard, where the LEI is already an element from, we see now a lot of interest in mandating the LEI in the payment space. And we're very happy also about the recommendations from CPMI and the FSB. Just the other day, they published a new report where they mentioned the LEI very prominently for payments. You've all heard about the problem of correspondent banking. That's another area where the LEI is considered, and there might be even pilot projects coming out of this discussion. The LEI today is a 20-digit code. You could call it a database key of some kind. So you can access information, you can link information, and so forth. But what it lacks is a digital identity, something that is cryptographically sound and secured. Clive has an enormous interest in, bringing the LEI up to speed with developments and technology, especially in areas like cryptocurrencies, blockchain, and others. but many other types of applications as well. And there are two technology fields that we have engaged with and that we are supporting. One is the more matured digital certificate industry, where we have lots of issuers and millions of certificates issued. ISO has just recently published a standard on how to include the LEI in digital certificates. And this has been picked up by regulators, for instance, in Europe, in their digital signatory laws. On the horizon, we already see the next wave of technology, and that really comes out of the blockchain discussion. It has the technical title verifiable credentials. That's a standard from the W3C organization. But it basically means a decentralized identity management in a hierarchy where, let me give you one example how this could be built for the LEI, where GLIFE would issue credentials and allow organizations to issue digital identities. Those digital identity issuer could then issue identities to firms around the world. And these firms can then use the platform to issue digital identities to their staff, to their corporate officers, and some think of even suppliers and customers. I would like to stop here with my little outlook. If there are any questions from the group, I would be very happy to answer them.
If I may, Stephen, just to make sure that the message of GLIF is basically fully understood, and try to also link it to our policy briefs that we are discussing in this task force. How do you see linking those subjects? And for example, we have one of the policies that we are discussing, what they call it, the global financial safety net around the globe. And I think AI can play a role. And this is my guess, please, I need your view. Also, when we talk about the big tech companies and their database and their links and their information and data that they're dealing with and how we link it to each other. Also, we talk about the digital money overall, and also sovereign debt, which is become a huge number. How LEI can help? And first, and before that, if you can just make us, in the first place, why LEI being basically adopted by regulators after the financial crisis? If you give us the main reason and objectives that driving to create such system. Thank you.
Thank you. I'm very happy to take these questions. Let me start with the last comment. Why did regulators decide to use the LEI in regulation? It is very important that in many countries you have a proper national ID system in place. Not in all countries, of course not, but in the major countries you would see local registration authorities like business registries and others. However, nothing of this works cross-border. So the moment you want to engage in trade with somebody else that probably sits in another country, then all of a sudden the national ID schemes won't help very much any longer. It's difficult to access the information. It is probably in a different language that you can't understand. We have an example where a European company wanted to trade with a Japanese company, and the time for translating all the Japanese documents into English by notary and everything else would have taken longer than the onboarding time of the client permitted. And so they decided to use the LEI information instead, and voila, they could onboard the client immediately. The LEI is use case agnostic. So we can't say it's a financial instrument or it's a supply chain instrument or whatever. It is the identification piece for legal entities, and with our digital approach also for representatives of those legal entities on a global scale. As you rightfully pointed out, the sovereign debt, the bond market in particular, is a very international market. So what you would like to see is a link between the issuer of a bond and the issue itself, the instrument itself. And I'm very happy to let you know that we're working closely together with the International Numbering Organization, ANA, for creating and maintaining a link between the LEI and the ISIN as instrument code. Our regulatory oversight committee is currently working on a policy for public issuers, for government issuers of bonds, and we're going to incorporate this into the system as soon as the policy arrives. There are other topics, and I want to be very brief. I could talk about these use cases for quite a long time, but one thing that is very important at the moment is sustainability and inclusion, and I saw this in your background. We believe that we should not rely only on very large big tech platforms that grant an identity. We should build a system where each legal entity owns its own identity and can use it with any other platform. And we believe this is an important first step. And for asset managers, for instance, this is a very important piece of information that they could use when they put their portfolios together on companies that work in the various sectors. Again, the LEI is the linchpin, the connecting piece between lots of different data sources that all come together at that point.
My last question before just move on. LEI is not just a number or reference number, it's also a data set that's required by the entities to provide those information. If you can elaborate more on this, Stefano.
So would you allow me to share my screen for a moment? So you can see my screen. This is our homepage, and I thought it would be the easiest to show you an LEI. For instance, I could type in the name of a company. This is a Swiss chemical firm, pharmaceutical firm. And here you would see the LEI number, which is a code without any semantic. It's just a dumb number, 20-digit long. But it links to reference information, such as the legal name, where the company is registered, under which number it is registered in the local registry, in which country it is registered, and what legal form. There's a new standard from ISO, what legal form this company has chosen. And as you can see here, Novartis AG seems to be an easy example, but if you see Novartis AG, Novartis A.G. Novartis Aktiengesellschaft, and all other language permutations, if you want to find out whom you're doing business with just by comparing names, it is a real hassle for most, if not a real burden for everyone. And the LEI solves that issue. As you can see here, we have the link to the BIC code. That is also the reference for Swift messages. We have the link to the ISIN code from Novartis. We have the headquarters address and legal domicile address, which are the same in this case, but in many other countries you have, for instance, a company registered in Delaware operating out of New York. Some registration details, and most importantly, you see the ownership structure of Novartis concerning their subsidiaries. This is not a complete tree. This is not a complete hierarchy of ownership. This is only for firms that do accounting consolidation of the subsidiaries, and those subsidiaries have to apply for an LEI themselves, so they must be eligible for an LEI. But as you can see here, Novartis, the chemical firm, has a number of subsidiaries registered with the global LEI system, and altogether, the information that we call the business card information, together with the ownership information, enables users of the data to aggregate the data in a completely different fashion. Think of risk management and other important duties.
I think, do you have any more points, Stephen, you want to give us those notes before we really say thank you?
No, thank you very much. And I wish you a very successful meeting today. And again, thank you for having me here today.
Appreciate your accepting our invitation, and hopefully to see you soon after COVID-19 over.
Yep.
Thank you.
Thank you.
Well, thank you so much, Stephen, for this informative opening remarks. And just to save the time, we're going to start our first panel of the 3 panels in this webinar. This panel is going to be moderated by Jose Siret. He is the co-chair of our task force and counselor member of Argentina Council Foreign Relations. And the panelists will be our lead co-authors of our policy briefs that were published. First, Claudio Lopez, the head of research at Milken Institute, and Bernard Dryox, a research fellow here at CAPSAR. So the floor is yours, Jose, to start this panel. Mm-hmm.
Thank you. Well, thank you to all. Let me say that we will talk about digital money, digital finance. We will talk about stable coins, central bank digital currencies, about big tech, and many other things related with digital and digital impact in the financial field. Digitalization is reshaping societies in almost every activity. It's driving financial innovations. We have now different money and payment systems and models. That was a very boring area since a few years ago. We will expect to have very different banking and credit models in the near futures. There are new players coming to this field. Big tech are entering finance, for example, and they are bigger than our biggest banks, which are deemed to be too big to fail. Just to notice the potential impact of having these new players in the field. One of their projects, the Libra project, sponsored by Facebook, among others, was a kind of wake-up call in this field. Just a single fact, Facebook's user base equals close to 40% of the world population. So this is not a tiny project. This is a giant platform, and there are others like Amazon, Google, Alibaba, and others that could develop their own digital currencies and tie them to the multiple data, trade, and social service they are already running, and they might provide everything, including their own currencies, in an integrated client package. And believe me, this has been a shock for the well-established financial system, and I mean the central banks too. So even though Libra might never fly due to its ill design and regulatory zeal, it is understood that the underlying idea is out of the Pandora box now. So central bank digital currencies are coming. You have the Chinese example, the DCEP, digital currency electronic payment currency, being tested since April in 4 cities of China. The Bahamas Central Bank is launching its Sand Dollar CBDC in October. And the ECB has said that maybe by mid 2021, they will decide if they follow with a project of a central bank digital currency. And its executive board member, Fabio Panetta, has said, we need to make us sure that our currency is fit for the future. Inaction is not an option. So this is a field very buoyant right now. You might say in aggregate that this digitalization process will entail increased competition and potential financial stability risks in the future. So we have urged the G20 to develop a comprehensive agenda with a systemic vision in order to guide the financial system through a very prudent transition process to be able to keep pace with technology and to deliver the long-term benefits to society promised by innovation. This means many things. I would say in a microeconomic view, you have to deal with payment systems and try to understand safety, efficiency, and integrity of payment systems. After innovation, you have to think about new instruments and procedures, their legal entity and governance. You have to think about market integrity and competition, cybersecurity, operational resilience. You have to protect consumers, investors, data privacy, portability. You have to take into consideration ESG factors, tax compliance, compliance with norms against illicit finance, and there's quite a long list. I would say what is crucial is to establish correct design principles from an early stage of the digitalization process, and to be able to craft a very careful transition to address these new risks that might arise. You might have a whole bunch of financial stability risks involved and many new economic policy trade-offs, and they require international cooperation to function properly because digitalization is not bounded by geographical limits. So we have recommended the G20 to take care of these, to perform the analysis of new digital instruments and procedures, but mainly we have recommended it to think about the framework for the integration of these new instruments into the existing financial architecture, both with a national and international perspective. This transition to digital implies the possibility of a period of higher financial stability risks. So timing, implementation should be carefully handled. There are many attractive innovations, but they need to be well understood. Many of them are untested in a real world context on the scale required. So that will demand previous empirical research, local pilots. I would say in the very short term, there are many lower hanging fruit that could be collected, I would say, by taming the two major flaws current payment systems have. That is the lack of a universal access to financial services for a large share of the world's population and quite inefficient cross-border retail payments. I would add that given time and the appropriate architecture in place, digital money could improve payment infrastructure, financial inclusion and stability, market integrity, monetary policy effectiveness, and even if the political will is there, it will help mitigate failings in the international monetary system. This is what we propose. What the G20 is doing? Well, this is working, I would say, pari passu. The G20 has made, in the Saudi Arabian presidency, enhanced payments a priority. The BIS and the central banks of the G7 last week published a document on central bank digital currencies, and they are defining their three foundational principles: do no harm, coexistence, and innovation and efficiency. I would say that we have considered a broader agenda, and what the BIS is saying, we will tackle this agenda in a very prudent way. So we will put priorities on, for example, coexistence, when the new digital field allows for very fierce competition among different monies and payment systems. So this is a very huge agenda. Core features have been defined by the BIS and the central banks of the G7 in terms of instruments, systems, and institutions needed. They have defined that they will like to start with CBDCs that are convertible at par with cash and private money. You might think of a world where CBDC might compete with, for example, commercial backed monies. So this is a very broad, very large field that it is opening. One last thing we have to stress is that maybe the best system is a system that combines digital with conventional. You might say the pandemic has stressed the importance of having digital payment systems. It has been a nightmare for conventional monies. Due to public health considerations, digital is way superior and more compatible with restrictions on social distances relative than conventional. But you have to think that even though the COVID-19 virus has been very negative relative to the use of conventional. They might be another virus, other virus, I would say cyber virus, that in the future might hurt the digital part of your system, and the conventional one might be better. So this is a field where early in the field we let regulators and supervisors in. They are very late. The system knows their own dynamics will have to run from mine. So this is a very huge interaction, and I will let, in the first round, co-authors talk about their work, and then we will have a second round where we will talk each other and have a conversation or answer questions from the audience. So please, Claude, the floor is yours. Please tell us what you have been working on.
Thank you, Jose. Hi, everybody. I'm very happy to be able to join, even though it's via the internet. So, well, Jose, you just covered pretty much everything, but as you said, the most important part is the digitalization. And so whenever we talk about digitalization, we talk about all those digital platforms, and the piece that we wrote for the T20 is looking at big tech and potential regulation. If you look at the state of things as of today, you really saw that even yesterday, the European came up with another idea of regulation. And however, whenever we talk about big tech, depending on where you're located in the world, you may be more focusing on the one in China or the one in the US. Overall, what's so special about those companies is that they are extremely big. They have access to a lot of data. They have access to a fantastic platform of clients, a lot of network effects, and have a lot of different type of businesses. And because they are so new and their business model is so different than anything that has already existed, there's really no real regulatory framework or even regulatory authority who can actually really assess the fully type of benefits and risks that they actually bring. And that's exactly what we're pushing in that report to avoid what is happening right now, which is a very fragmented approach to regulation and monitoring of their activities. So of course, depending on where you're located, whether you are in a developed or emerging economy, or if you're in developed countries, your focus may be different. Whenever you look at big tech, and initially the topic was to really focus on financial issues, then we realized that whenever we combine financial, the financial inclusion that those platforms are able to bring, and that is often one of the topics brought by population in emerging countries, come from the fact that those companies have the infrastructure, which usually come with a monopoly, that allows them to collect information, and so they can assess the risk, and so they are able to provide finance to a population that usually has been ignored. Well, on the other hand, whenever you could look at exactly the same thing and realize that if you have one big platform that actually can use a lot of different information and centralize a lot of information and financial activity, that platform that benefit create financial inclusion can also be a problem for financial stability. The same way, we see that the value of data, private data, is perceived quite differently depending on what is your priorities in the country you are. If you really are craving for a capital access, then in the short term, you're willing to give access to your information. In more advanced economy, then data, which is such a valuable good and quite a risky one, protection of it become a priority. And so what we end up seeing is there's a lot of different push for regulation and different trend depending on where you are. And that's where we strongly believe that it's a question for the G20, because whenever we talk about those big companies, we talk about companies that have a lot of activities that are cross borders. And so the regulatory and monetary frameworks that need to be applied need to be discussed at a global level. how to do that? Well, what we suggest is a way of reconciling all those different trade-offs, and I discussed a few of them. The first one will be whenever we come to capital access, all the issue of financial stability and financial integration can really be bundled under that. The second point will be very much looking at the market structure. So we talk about market efficiency, but we also need to talk about antitrust, and there is a lot of push from few countries on the antitrust, but whatever regulation there is, we know that there will be spillovers beyond those specific countries. And what we want to make sure is whenever we design this regulatory framework for the future, we take into account or we try to minimize all those unexpected consequences. During the introduction, you were referring to the financial stability and the financial crisis, and what we learned with all the macroprudential, Basel III and so forth, is that there is always some unexpected consequences. So because technology, digitalization is the economy of tomorrow, trying to minimize those things would be very useful, and that will allow that framework to be extremely inclusive. And finally, the last point is about consumer experience. I mean, the key point of all those different big digital platforms is access to information that facilitate consumer experience. It is part of consumer welfare. However, they need to be a closer look regarding the data usage and also how it can be protected. I think I'm going to stop here. It was just a short introduction.
Thank you, Claude. Bertrand, it's your turn, please.
Hi, Jose, sorry.
Hi, how are you?
Hi. Great. Yeah, so just keeping, I guess, with the flow, I had a slide deck, but there's no real fancy graphics in there. So I'll run through the text and run you guys through the work we've done on stablecoins, just briefly. So just to give people a perspective, I mean, digital money itself is not a new thing. It's sort of been happening organically, over the past decades. But what's the difference between this whole advent of cryptocurrencies and stablecoins is really a transition in how digital money is represented. I mean, traditional digital money, it's linked to our banks, our credit card providers, what have you. We're now moving to a system where it's not tied to a single institution or entity. We have this idea of not having a single counterparty involved, and it becomes really a form of digital cash. It's not just a digital representation of your holdings with an entity, but a form of digital cash. And this has real advantages, and these were mentioned before. Things like providing access to financial services to people in unbanked regions or regions without access to financial services. They don't need a bank account, but also enabling better communication across borders. So these are the real advent of what we mean by cryptocurrency and stablecoins. So, stablecoins were initially just an advent to try and find a way to stabilize trading activities in more volatile cryptocurrency markets. But what happened and what we've seen is that big tech has gotten involved and says, well, you know what, we can do this as well. And what we can do is find a quick way to digitalize traditional currencies. Take those currencies, create baskets of currencies, basket of other assets, highly stable assets, say like treasury bills, and turn them into a digital money that is much more flexible. Now, what we've looked at in our policy proposal is to call on the G20 to really investigate the risks of this significant change in the way money is used, particularly the involvement by privately owned and issued stablecoin companies. Why? Well, yes, because of this better integration with digital platforms, it can really be massively deployed. Has these strong networking effects that can really be well suited to the growing digital economy. So there's a real value there, but obviously there are huge risks associated with transitioning to a new payment system. This also, I mean, has an elevated importance during the recent COVID-19 pandemic, as these types of payment systems can really answer to the social distancing response measures and providing like a contactless virtual payment system. Excuse me. So it's been well recognized. I mean, the IMF has looked at this, the BIS, that these widely circulated forms of money are going to face increasing competition and they can be overtaken. So this is well recognized. Now, the issue is how stable are these mechanisms that are being put in place to operate stablecoins? The currency baskets that they operate, this sort of transformation, taking currency and turning it into a digital cash. How stable are they? And also, will they really provide an advantage because of perhaps achieving greater stability against prevailing dominant currencies? So this is something to consider. Consumers may see, oh, well, not only does this digital currency provide me greater flexibility, but it offers a more stable store of value. Now, a major issue, and this is one thing we looked at leveraging work that was done by our co-authors, including Egi Ogawa from Japan, is that a shock-induced shift that would move liquidity away from internationally dominant currencies like the US dollar could have a significant disruption on exchange market dynamics. If high liquidity is achieved using this new payment scheme in cross-border payments, operational difficulties due to a lack of regulation or oversight in the underlying companies could create significant negative cross-border externalities, which would have a spillover effect. So what we propose, simply to encourage the D20 first to consider broad regulatory measures that have already been proposed and introduced by the FSB, Financial Stability Board, published in early 2020. But to add to this, we propose some specific actions that we believe should be taken in considering the rollout of stablecoins. First is for the G20 and the IMF to cooperate on studying the lending risks and how liquid stablecoins impact sovereign foreign currencies, foreign exchange markets, and capital flows. There's a potential there. We need to understand it. More concretely, there should be an adaptation of regulations that are specific to managing the stabilization mechanisms of these companies that are offering this digital currency and the institutional risks that they hold. We propose the creation of additional loss absorbency and minimum capital adequacy requirements for such institutions, and the idea of creating liquidity coverage and net stable funding ratios to secure sufficient reserves of highly liquid assets if these stablecoins were to roll out. The last points that we discussed in our policy brief was really the collaboration with big tech, and also the idea of central bank digital currencies, something that's been discussed in the panel today and is gaining traction. So there's a lot of skills and innovation that has evolved within the big tech firms and financial institutions. There needs to be a collaboration to understand how these can best be applied to the monetary policy environment. So that is, how can one use, for example, CBDCs or collaboration with private stablecoin offerings, ways to coordinate monetary policies, nominal interest rates, forward guidance, to help create a more stable financial system. And also just to use CBDCs perhaps to support growth and currency stability for the digital economy as the digital economy expands and could represent more than 70% of additional value generated over the next decade, according to the WF. The last thing I'll talk about, and I'll end my discussion, is really on the solutions related to the security of client money. And this gets back to the idea of identifiers, legal identity identifiers, and the glyph, as our panel host introduced, or the session host introduced from the beginning. So there is no single counterparty. So exploring the idea of a legal entity identifier requirement for stablecoin networks themselves, which is a group of organizations, as well as the individual operators. So the companies, the consortium that enable the network to function. And finally, creating greater public awareness and standards for the use of the concept of decentralized identifiers, and that is the financial identity mechanism that enables the use of such peer-to-peer digital cash. Thank you.
Okay, thank you, Bertrand. Thank you, Claude. I think we have a time for some conversation among us. I would start saying that in 2018, during Argentina's G20, this task force published a paper on crypto assets and published the prevailing view in 2018, 2 years ago. on crypto assets, but by the same type of experts that are leading the main financial institutions, the BIS, etc. And what I regard was that their opinion on crypto assets, mainly Bitcoin, but they were talking generally, was that this was a fraud. I remember Jamie Dimon saying that, he who manages JP Morgan. Or Ponzi scheme. I remember the head of the World Bank saying that. The mother of all bubbles, for example, Nouriel Roubini, the economist. And Agustin Carstens, who is the general manager of the BIS. Yeah, I think he came with a more elaborate thinking, saying this was a combination of a Ponzi scheme, a bubble, and an environmental disaster. That was then. Then a second generation of crypto assets came to play, and those were the stable coins, not the global stable coins, mainly the tethers and those type of things that maybe have a very weak architecture behind. But the stable coins were able to provide better monetary services than Bitcoin, Ripple, or Ethereum. Then came Libra in June 2019. And then 1 month after Libra, Mr. Carstens appeared again, saying central banks might be issuing their own digital currencies sooner than expected. I come with this comment because it shows the velocity or the speed change, the financial change is proceeding at. This is very, very quick. So I think now we have done our work in 2020. We will have to think what type of things might we be writing in 2022, for example, 2 years from now. And these are my questions. For example, for Claude, what do you think big tech will be at that stage? The OECD has been discussing putting taxes on big tech. There was now a share position. So my question is, where do you think big tech will be? Will be the giant platforms they are now? Might be regulators step inside and divide these companies? Will they be taxed? How will this affect the financial side? And for you, Bertrand, about stablecoins, what stablecoins are regulators talking about? Because they have make a lot of work. Are they talking about Tether? Are they talking about the stablecoins? They exist right now? Certainly not. They are talking about what stablecoin, what type of competition they think they might face, and they are trying to regulate right now before it becomes a fierce force. And I think maybe it's a stablecoin that's not backed by conventional currencies. Maybe big tech can issue their own money without a reference on conventional money. So these are my two questions for you guys. Claude, please.
So yeah, thanks. So let me take my crystal ball and
Yeah.
tell you what the future is going to be. Sure.
What do you think?
No, but that's a good. I mean, big tech is just one thing of that illustrates an evolution. That's the fourth industrial revolution. So what we're going to see is there is several platforms anyway. So what we need is for those platforms to be able to function together. So what you can see is a summation of smaller environments. There won't be one big tech. Same thing with currencies. I don't see one big currency that can work everywhere, but they need to be interoperability. Then, of course, what one can hope is that because that's the economy of the future, there will be interaction between regulators and those big technological firms, because they're not really technological firms anymore. Even though the innovation come from the technologies, they are in so many different places and part of the economy that they will have to be considered differently. And finally, I think what is extremely that should be expected, and that's exactly what we see from the rate of change regarding the regulator standing point. Whenever you talk about digital money, they need to be more and more understanding of what are the issues. And for that, what does that mean? That means that it's not only about financial regulation or financial regulators. You need to have some tech regulators. You need to have entities that understand technology, understand digitalization, but also understand economy. Understand financial system. And whenever you have a healthy discussion among all those worlds, what you can have is a world where there is more competition, easier access to capital, and so very much support growth and in a sustainable manner. Because when the first round of a digital currency or cryptocurrency was occurred, the Bitcoin, we all agree that that was not sustainable. I mean, the mining process was clearly not respecting all those environments, but there is an evolution. So what I believe is that in the future, there need to be more coordination, geographically speaking, and across a lot of different entities, and there will be also competition among a lot of different entities, and maybe the discussion is going to shift from big tech to just technology, because there will be a lot of efficiency coming from there too. I think I'm going to stop
Thank you,
there.
Carla. Thanks.
Let
Bertrand?
me try and wrap this up quickly about the future of stablecoins. First, I'd just like to address some comments about Bitcoin. Bitcoin does get a lot of negative rap because of some of its flaws as the first cryptocurrency, and these need to be recognized, and I don't want to undermine that. But it's important to look at the sort of ethos and the core of the Bitcoin network, just as sort of setting the stage for cryptocurrency stablecoins moving forward. And that's that the people that operate this network, which is literally the people, it's decentralized, they really care about operating it, and they have proven, if you look into the history of issues that the networks have faced, the people that operate it have responded quickly to address them. And that's really the power of these networks, is that the people care, and they have invested in it to keep it functional. Now, moving on to stablecoins, and to address Jose's question about how it will move forward. Are we looking at stablecoins that are backed by baskets of currencies or other assets, or a completely new or a different vision for stablecoins that doesn't require any backing, and it's basically just private companies issuing their own currency? Well, to that point, that's already being done. They may not be called stablecoins. There are, stabilization mechanisms that are completely non-currency backed, but this is already happening. You have dozens, if not hundreds, probably dozens of really rigorous digital money offerings that are in existence today. But they tend to be focused on specific digital applications, digital platforms. But it's already happening. That you can't stop. The issue is these are not reaching the sort of scale or liquidity that can really challenge, traditional currency markets. And that's where I think stable coins that are backed by currency reserves really, really pose a real challenge. And I really think there is something there moving forward. Now, if we look at Libra project, as far as the challenges that it's faced, the barriers that it's faced, we look back a year, basically, the G7 and other big financial entities have stepped forward and basically said, we don't want this happening right now. And that had a backlash, and that partners in the Facebook or the Libra project pulled out. Now, if we look closer to today, even within the past week, the G7 has announced a similar statement, but with a slight revision, is that we don't want to see these stablecoins happening until there's a clear regulatory framework in place. And moving into 2021, work by researchers such as myself and others, my co-authors and others, is really to look at, okay, well, we need to now start establishing a clear regulatory framework in which stablecoin operators can, enter the market, create competition, such that the benefits of this new form of digital money can be realized. And that's what I think we're missing today, is really to have clear regulatory guidelines that are internationally recognized, say amongst the G20 community, that can really enable this new form of transaction between peers to start rolling out. I'll leave it at that.
Okay, thank you, Claude. Thank you, Bertrand. I think we have make an extensive use of our time. Our message is this is a field that has come here and will stay, will provide a lot of news, and we have only tried to show you our work and what might come in the next few years. Would any of you want to add anything? This is your last chance. Okay, Thank you, Mal. Giving the floor to you. Do we still have time? We can use the time, but I was checking the timetable. I don't listen to you. I cannot hear.
Okay, thank you so much for this
Thank you.
very
It was
informative.
too early? Was it too early or what?
No, I mean, the time is up. Thank you so much for this very informative panel. Jose, Partnered, and Claude, we're so grateful for hearing what you have said. These are very valuable and important information. And now, actually, art is a universal language, transcending barriers of language and time. And T20 uses art to communicate its themes, priorities, and policy recommendations to all. We're grateful to welcome Fahad Al-Khlayef. He is a Saudi artist who was born in Beljurashi, Saudi Arabia in 1972. He holds an MA in Fine Arts. In addition to being a full-time artist, Fahad is also supervisor and head of the Department of Art Education at the Office of Education in Jeddah. His artwork has been shown nationally, regionally, and internationally. The art piece is called Jeddah and is an acrylic on canvas. Am I right? This piece art by Fahad is a literal representation of architecture portraying windows and posts, as well as metaphorical representation of financial architecture showcasing windows of opportunities, boats of trade, and trees of prosperity. Scattered through the art piece are minarets, asking us to engage in financial activities with integrity, honesty, and with gravitas. Now we're going to watch the video of the art piece, and an English-Arabic translation is available. So select the audio language by clicking the interpretation tab at the bottom of the screen in Zoom.
مدينة جدة، ذلك العنوان العريض الذي تلخصه تلك اللوحة بتلك المفردات البسيطة، تلك المفردات التي هي مخزوني البصري من خلال حياتي في هذه المدينة الجميلة لمدة 25 عاماً. جدة مليئة بتلك المفردات الجميلة، مليئة بالحراك التشكيلي، مليئة بالحراك البصري الكبير، مليئة بتلك الألوان التي يكسوها بياض تلك المباني الجميلة، ممتزجاً بزرقة البحر، برائحة البحر الجميلة. هذا العمل التشكيلي له ارتباط وثيق بالاقتصاد، حيث أن جدة هي بوابة الاقتصاد للمملكة العربية السعودية، هي أهم بوابة، هو ميناء جدة الإسلامي. جدة أيضاً مركز ثقافات متعددة، كل الجنسيات نجدها في جدة، نجد ثقافات متعددة، نجد حراك تجاري عظيم في هذه المدينة. حرصت هنا في العمل التشكيلي أن يكون عمل غير مقفل، عمل ممتد أفقياً، ممتد طولياً أيضاً. فهذا العمل هذا احنا نتحدث عن نمو، نتحدث عن لا نهاية. أيضا الاقتصاد أنا أرى أنه فيه نمو، أرى أنه فيه لا نهاية. مدينة جدة هي فرصة عظيمة لكل مبدع، فرصة عظيمة للشاعر، فرصة عظيمة للفنان التشكيلي، فرصة عظيمة للكاتب، فرصة عظيمة للمصور، فرصة عظيمة للمسرحي. الخلاصة هي فرصة عظيمة للإبداع.
So we're so glad to have Fahad with us today. I truly liked the piece, the art piece. It's a really creative one. And we're so glad to have him today with us to speak about his art piece. Again, he's going to speak in Arabic. There's a interpretation. You can read the English translation by clicking on the interpretation button tab on the bottom of the Zoom screen. So welcome Fahad, and the floor is yours to speak about your art piece.
أهلا بكم. السلام عليكم ورحمة الله وبركاته. وأسعد الله مساكم جميعا. سعيد جدا أن أكون في هذا المنتدى الاقتصادي الثقافي. سعيد جدا أن أتحدث عن هذه التجربة، تجربة الفن التشكيلي أو تجربة لوحة مدينة جدة. لوحة مدينة جدة ليست مجرد ممارسة لحظية، ليست مجرد إسقاط بصري على سطح اللوحة في ساعات أو في أيام. هي رحلة عمر، هي رحلة حياة. اسمحوا لي أن أتحدث عن بداية المولد والنشأة. على قمم جبال الصروات في منطقة الباحة، وتحديداً في مدينة بلجرشي، ولدت وترعرعت ونشأت. بدأت أتلمس تلك الثقافات الفريدة. ثقافة منطقة الباحة هي ثقافة أصيلة، ثقافة فريدة في مضمونها، في محتواها، ثقافة فريدة في طابعها المعماري، في طابعها الزخرفي، في طابعها الثقافي أيضاً، وأيضاً طابعها المجتمعي. هذه هي أهم مكونات الفنان التشكيلي. هذه هي أهم مكونات الفنان التشكيلي التي تصقل موهبة الفنان وتصنع منه فنان. هناك محطات يجب أن نتحدث عنها حتى تكونت لدي هذه الرؤية، تكونت بالأصح هذه اللوحة، نشأت هذه اللوحة. حقيقة منطقة الباحة لها طابع معماري فريد، يمتاز بالكم الزخرفي الهائل على المكملات الخشبية في العمارة الشعبية، يمتاز بفلكلور شعبي خاص. لذلك أصبح لدي مخزون بصري ومخزون سماعي كبير جدا من تلك الحكايات ومن تلك الملامس على تلك الحوائط، على تلك الأبواب، على تلك النوافذ، على تلك الأساطير، على تلك التي نعيشها ونتعايشها في المنطقة. منطقة هي منطقة باردة معتدلة صيفا، باردة شتاء، أمطارها غزيرة، خضرتها تمتاز بالخضرة، تمتاز بالتعدد اللوني، تمتاز بطبيعة خلابة. انتقلت أيضا إلى المرحلة الثانية لدراسة المرحلة الجامعية في مدينة مكة المكرمة في جامعة أم القرى قسم التربية الفنية، حيث أعتبرها المحطة التي رسخت لدي الحس الجمالي الروحاني. حقيقة مكة المكرمة كنا نرى في شاشات التلفزيون تلك الروحانية في الحركة الدائرية للطواف، في الابتهالات، في حركات الحجيج. أصبحت بالنسبة لي واقعاً في مرحلة الشباب أو المرحلة الجامعية. أصبحت متعايش لهذه الحياة، أصبح عندي حس روحاني عالي، حس فيه سمو، فيه علو، فيه حراك بالأصح. تأتي المرحلة الثالثة وهي بالنسبة لي تعتبر المرحلة الأخيرة، وهي المرحلة الوظيفية في مدينة جدة، والتي هي موضوع اللوحة وحياة اللوحة هذه أيضا. مدينة جدة تعتبر مدينة صاخبة بالثقافة، صاخبة يوجد بها انفجار ثقافي ومعرفي هائل بشكل يومي. جدة هي التقاء للحضارات، التقاء للثقافات. أسكن بجوار رجل أو عائلة من شرق آسيا، أو جاري الثاني من أوروبا، جاري الثالث من أمريكا، جاري الرابع من أفريقيا. لذلك أصبحت هناك ثقافات متعددة، أصبحت أنهل من هذه الثقافات لتتكون مع ما رسخ في داخلي وأنا طفل. هناك انفجار ثقافي من خلال جمعيات الثقافة والفنون، من خلال الصالات التشكيلية. أصبح هناك مزيج من الحضارات، أصبح هناك مزيج من الثقافات. جدة أيضا تمتاز بالحراك القوي، الحراك اللي هو الاقتصادي العالي جدا. جدة هي بوابة المملكة، أنا أعتبرها في اللي هو الميناء جدة الإسلامي بوابة الاقتصادية. جدة هي عروس البحر الأحمر، هي جمال أو عروس جمال المدينة التي تقع على البحر، المدينة التي لا تنام، مليئة بالأضواء، مليئة بالحراك، مليئة بالازدحام، مليئة إذن كل هذه المكونات صنعت بداخلي كفنان غزير بالمخزون البصري العالي. العمل التشكيلي الذي هو جدة أنا ربطته بالاقتصاد، لأن جدة بوابة الاقتصاد، يظهر من خلال العمل أيضا اللي هو الامتداد الأفقي والامتداد الطولي في العمل التشكيلي. لذلك أنا أتحدث عن أن هناك لا نهاية في الطموح، لا نهاية في الارتقاء، لا نهاية في النهل من الثقافة، لا نهاية للاقتصاد. لذلك في هناك خطوط طولية وخطوط عرضية هي مكونات العمل. هناك أيضا العمل التشكيلي فيه مفردات بسيطة. المفردات البسيطة هذه لم تصل لهذه البساطة بهذه السهولة، لم تصل بهذه البساطة إلا من خلال تلك النوافذ وخلال تلك الرواشين التي في العمارة الموجودة بمدينة جدة، مصقولة بما عشته في منطقة الباحة، بما عشته في مدينة مكة المكرمة. تلك الروحانيات تظهر في تلك المآذن التي شامخة بالعمل التشكيلي مع بزوق ذلك النخل الجميل الذي هو اقتصاد قوي في الناحية الزراعية بالنسبة لنا. رسوخ تلك القوارب الهادئة كأنها تقول أنها فترة استراحة لهؤلاء الصيادين. البياض الذي موجود باللوحة متجانس مع اللون الأزرق اللي هي لون المباني، مع زرقة البحر، مع نسيم البحر. هنا تكون العمل التشكيلي. أخذتكم في عالم واسع، ولكن هذا ما يكون الفنان، هذه هي الثقافة. وشكرا لكم.
شكرا جزيلا فهد. Thank you so much. It's always great to talk about art, so refreshing. For now, we're going to start our second panel, which will be moderated by Franco Bruni, the co-chair of our task force. And the panelists are Jose Sabio Sirait, Haiyong Gao, a professor director of Research Center for International Finance at the Chinese Academy of Social Science, and Gerardo Rodriguez, professor of national security at University de las Americas, Puebla. So Franco Bruni, you can start the panel right now.
Thank you. Can you hear me well?
Yes.
Yes,
Okay.
Franco.
The title of our panel is the reform to expand the global financial security net. And we do have three panelists that have contributed to several policy briefs that are relevant for this theme. We have Gao Haigong, who is among the authors of a brief which is called exactly Expanding the Global Financial Safety Net. So perhaps if Jose agrees, I would sort of leave Gao to go first, because it's then we have Jose, who is among the authors of many of our policy briefs. One on big tech companies with Claude Lopez, one on digital money, one on stable coins, and so on and so forth. And then we have Gerardo Rodriguez, who's among the authors of a paper on illicit financial flows. So everything is very relevant for our topic. And let me give the floor to maybe Gao as a first speaker to give us an idea of what has been their contribution to the works of this working force. Go ahead, Gao. Hi.
Hi, thank you so much, Franco. I'm very grateful to present on behalf of my co-authors. And it's such a privilege to work with the task force. I enjoyed very much. I still remember last time we meet face to face in a kickoff meeting. So I won't repeat our policy brief. I think you can find it in the website. I just wanted to emphasize a few points. And the first one is the crisis is far away from over, and the expected recovery will be, well, I quote IMF recent prediction, it's uneven and partial. So the global financial instability, well, has been the major challenges and is now still the challenges for the global economy, and will be continuing to be a major challenge in the foreseeable future. So it is very important to keep this global financial safety net updated in pace of the new development, so that it can perform effectively as the safeguard of the global financial stability. So this is the first point. We need to continue to update it with a very fashionable manner. And secondly, I think in a extreme situation like pandemic, every single action is important, but any single resources is not enough. So that is why we call in our policy brief for an expansion of a global financial safety net. Basically, it's a network that provides layers, options of financial support from various resources globally. So basically, the essence of this global financial safety net is that it provides a multiple layers. They are separated, but somehow they are interlinked. So this is the beauty of this network, so that we can make sure when the country in trouble, they can always find someone to help. So my concern is still about the emerging economies, because they are the most vulnerable spots in times of crisis. And normally, you know, it's the countries with a large capital account deficit, a large portion of external debt, especially denominated in foreign currencies, and with a very limited forex reserves. Those countries are very vulnerable to external shocks. And this pandemic actually widened the difference across countries. For those who have poor domestic social security network, a large unprotected workers and weak physical positions, those countries could face prolonged economic and financial damages. So what options do they have when they need help? First, defense lines, always the forex reserves. But unfortunately, we look globally into details of each countries, and basically there is uneven distributions, and not many people have a very good position. So basically, we look back in the past month, because it was a test. Basically, it was a test for this financial safety net. We saw there is a pattern for some countries that when they didn't have much reserves, and they have limited access to bilateral swaps, and they often, not covered by any other regional arrangement. They would like to look for capital control to some extent, or just let its currency be free to depreciate. So we saw a massive currency depreciation. This is not a surprise for many emerging economies. And I would also like to emphasize a regional financial arrangement. Basically, there are a number of regional financial arrangements. The Qingmai Initiative, multilateralization in Asia, and European stability mechanism, and also the Latin American Reserve Fund, FLAR. And in the Arab countries, there is an Arab Monetary Fund, which I think perhaps is one of the most active one during the pandemic. It provided a number of support for its member countries. But when we look at the activities in the past month, basically there are relatively inactive for many other regional arrangements. There are a lot of problems. We try to identify what's wrong, and then basically there are a large scope of room to improve. And of course, there are many countries that are not covered by any of regional support. Like Argentina is not part of any Turkey, which was really in trouble, are not covered. And of course, most countries went to the IMF. This is because the IMF has a broader membership, and also because the IMF has the relatively larger funding resources. So this basically leads to my last point. It is about IMF. So IMF actually is the center of everything when we talk about global financial safety net. And the key concern is still the capacity, the resources capacity of the IMF, because in the last, from March to August, the IMF actually provided 250 million loans. It's a quarter to its 1 trillion capacity. And out of it, 40% was disbursed through its emerging tools and the grants through the CCRT for poor countries. So there should be more demands. I think that recently the managing director, Georgieva, basically signaled that the fund needs to have a bazooka, so it needs more money. And the key problem in our policy brief, we think, is that the core resources of the IMF is a quarter, now accounted for half of this overall capacity. And another half basically relies on its new arrangement to borrow and bilateral arrangements, which needed to be renewed frequently. So those are actually the temporary based arrangement. This is not, the IMF basically is an institution there, and it's a quarter-based institution. So this is something we need to be more creative, to think about how to make the IMF more powerful in terms of the financial resources. And of course, there is a huge gap, and we have the number in our policy brief. And basically, there is an idea about SDR, the new SDR allocation in the first months of pandemic, and we basically support this idea to have this, basically the SDR is there, and why not we just activate like what the IMF did after 2008 global financial crisis. But somehow, it didn't work out. And I think it is reasonable to argue that, well, what if redistribution of existing unused SDR from rich countries to poor countries And that could be much better than a new allocation. This is something idea flowing recently. And now is the IMF is having, World Bank having the annual meetings. We don't know what's gonna happen, but we do hope there could be a surprise. But anyway, if the IMF realize there is a need to be more powerful, they need to do it now. So last words about this G20. I think G20 actually has done an excellent job this year, especially for this protection, layer protection efforts, and not only from financial stability, but also debt solution. And the T20, of course, the contribution is valuable, and especially valuable in this difficult time. So I'll stop there. Thank you very much. I'm very grateful.
Thank you, Gao. In fact, there is a very special role in bilateral financing that is now performed by China to sort of, in a way, help the financial situation of a certain group of countries. And maybe later we will have some questions for you on that if you have any comments. But let me give the floor to Jose for his own considerations on the topic.
Okay, thank you, Franco. It's a pleasure to see you. Hi, Hong. Let me start by saying that the pandemic should be a very good real-time example of a stress test, a true stress test for the global safety net or for the global financial system. And let us remember that in April, the quarantine destroyed 20 million jobs, net jobs, a little bit more than that, in just a month in the US. That's 14% of employment. That had never happened before. For the Great Depression, it took almost a year and a half to create the same destruction. So the real economy shock was outstanding. But when you look at the financial system, when you compare these with a Lehman crisis, with a great financial crisis, and with a great recession, which compare relative to these standards was quite small, because in the US, the Great Recession destroyed 8.5 million jobs. So that was what this crisis destroyed in 2 weeks. I would say you find no financial crash, no financial crisis, no banking crisis. So in a sense, the global safety net, as it was presented in Hai-Hon's paper, was at the end of the day, or up to the moment, it was not stress tested as one would have expected. And I think that highlights one key aspect of the safety net, which is that time you do not have to run and think about a new Basel system, Basel 4. Basel 3 was okay. Macroprudential regulation was okay. We invested ex ante in building resilience within the financial system, and against all the odds, it worked. We experienced a very short bear market and a very steep recession that started in the US in February. And I think by all conventional means, it ended in April. And in May, we had a very strong recovery. We cannot say we are in a new expansion phase due to the aspect that Hai-Hong also highlighted, that COVID-19 comes in waves. So I think the safety net and the financial system were able to weather the shock, the impact shock, which was tremendous. Had this been everything, has the pandemic been a single shock, our agenda should be to rebalance policies, progressively go back to normal, limit debt growth, and try to regain policy space for the next crisis. Unfortunately, the global infection is coming in a very strong second wave in Europe and parts of the US. So we cannot do that. A vaccine or a successful medical treatment are still on the horizon. I think they are part of the marketing tool to make people grow not so nervous, but we do not really know when this will be effective. And the adverse economic shocks or effects are far from over, as Haihon said, and they accumulate. So the global safety net and the financial system and the global economy is not out of the woods yet. So maybe the real stress test for the safety net will come in the months, in the next months. And I will stress that this financial safety net has limited resources relative to the magnitude of the shock. And if we will have to live together with an enduring COVID-19, further action will be required. Maybe other resources should be put in place. Do not remember that emerging markets economies went through the pandemic almost without damage, I would say. From the financial side, that was the case. There was a voluntary market unexpected safety net brought by markets that opened to new issuance of debt, from high quality debt, so quality debt, and even emerging market poor quality debt. Everyone was able to go to markets to issue new debt at very reasonable costs. So this was unexpected. I would say this is part of the work the G20, the FSB, the banks, everyone has been devoting resources and time to build this part, and I think that should be stressed. But this is obviously not enough. And the international monetary system lacks many key, I would say, resources, safety nets. It has many fragilities, and I think there's an urgency to deal with these debt fragilities, especially in case that these second or third waves are very strong. So I would say that after avoiding a liquidity crisis, for the weaker credits, emerging markets have no umbrella, have no central bank that they might might work for them, issuing a reserve currency. They have no those luxuries. So solvency might be the next problem in the international arena. Up to this moment, only Argentina and Ecuador were forced to refinance their debts. And they've done that during the pandemic in a very smooth way, taking advantage of another recent addition in the international framework, which is enhanced collective action clauses. They work pretty well. Both countries were able to reach an agreement with their private bondholders, and we have no default. We have gained, I would say, we have bought time. I'm not quite sure of the quality of the arrangements, but nonetheless, the liquidity problem has been pushed ahead, and there have been less than 1% holdouts. So for a structure that lacks a very specific debt resolution mechanism, this is also something to praise. But if the stress persists and the economic damages mount, I think we have to be working in trying to make this safety net more resourceful. The risk of sovereign debt stress within 2 years has more than doubled, from 11% as an average probability of some debt problem to 24% according to the IMF forecasting models. And I think we have to work in order to strengthen contractual provisions in that, improving debt transparency, and as you mentioned, Franco, getting all private and official stakeholders involved in an eventual restructuring process. And as the IMF, which is at the center of this process, has said, maybe drastic action is required, and it would be better to act preemptively, to restructure preemptively if the situation is very weak, and not to wait until the last minute. So one key aspect I think that will improve our safety action is getting everyone involved with indebtedness on the table and let them all participate in a common solution. So that would be my 2 cents up to this time. Thank you, Franco.
Thank you. The description that you made of your country's troubles and the ability to deal with them up to now has been encouraging. But your comments on what should follow are challenging. So let's go on.
We need to be 2 times lucky, not only one.
Yeah. Okay, let me give now the floor to Gerardo Rodriguez to give us his own comments on the topic, also based on his contribution with his working paper. Yeah.
Thank you, Franco. You hear me?
Yes.
Thank you. It's my great pleasure to present today our policy brief on monitoring countries' commitment against illicit financial flows on behalf of my colleague Aitor Perez from Elcano Royal Institute in Spain. First, we have to say that despite the international consensus on the need to tackle illicit financial flows, which materialized in the 2030 agenda, the UN has not agreed on a method for keeping track of this issue. While the quantification of IFF does not seem feasible, we argue that engagement against IFF can easily be measured by drawing on official and reliable sources that assess countries against standards on which they have previously agreed. An example of such a measurement is provided by drawing on the Financial Action Task Force peer review system. And it is suggested that the G20 use this to fill in this global governance gap. Also, while the quantification of illicit financial flows does not seem feasible, the drawing on official and reliable sources that assess countries' performance, for example, on the standards they have previously agreed according to the international consensus, the fight against hidden finance must be carried out using international financial transparency. We focus this paper on financial transparency. The FATF has the longest running mutual evaluation system. Its assessments not only refers to tax evasion, but also other offenses such as drug trafficking, like in my country, Mexico, organized crime, corruption, and tax evasion. Despite their strength, little attention is paid to FATF reports by either political leaders or public opinion, full of rich description and technical details. They lack of synthetic scores that enable the understanding of each country's performance and its comparison with other countries. It is worth noting that the FATF and many international organizations that generate an abundance of statistics are aware of how their findings can be used to name and shame the least compliant countries. However, for obvious reasons, their secretariats are reluctant to generate controversies around rankings with member states unless such rankings are requested by those countries, or at least by an influential group of countries. Subsequently, the G20 has a role to play in enforcing international agreements against illicit financial flows. The G20 provides additional support to international financial transparency initiatives through communiques following the meetings of finance ministers and central banks governors, such as in the G20 summit in Argentina. And based on the above analysis, Aitor and me, we have 3 recommendations that can be provided to the G20 and its member states to increase the effectiveness of international standards on financial transparency. First, shift the focus of international monitoring initiatives from illicit financial flows to financial transparency. Illicit financial flows are hidden by nature and are therefore difficult to measure. It is therefore suggested that countries' accountability with regards to IFF be increased by measuring the degree of compliance of each country with such standards. Second, adopt the FATF compliance indicators and similar indicators. From a technical standpoint, official indicators on financial transparency could be produced and communicated by intergovernmental institutions that have made a specific and practical contribution to the international agenda on financial transparency. Finally, tap into the G20 comparative advantage to strengthen peer pressure on financial transparency. The recommendation consists of ranking and comparing countries on the sensitive issue of the fight against dirty money. And as such, it requires political impetus. This can be provided by the G20. This initiative would necessarily have to be launched by the G20 heads of states and governments, but the finance ministers and the central governors could ensure its correct functioning. Finally, thanks to Saudi Arabia for the extraordinary organization of this G20 and for sure the G20 summit. Thank you, Amal. Thank you, Franco. Thank you, all of you.
Well, thank you to you. We still have maybe 5 minutes for interactions. I have a consideration for Haigong, if possible. And it's about the role of China in the global debt problem of the moment, especially for poorest countries. We know that IDA countries, the poorest countries of the world, have a very small amount of multilateral support. They are mainly financed, as far as their external debt is concerned, on a bilateral basis. And it's well known that China is one of the major lenders to these countries. During the pandemic lockdown, we have had this decision to suspend the service of debt for many of these countries, and perhaps in the future, solutions like debt cancellation, partial or total debt cancellation, will have to be taken. And my question to Haigong, if possible, but anybody who has considerations, is the following. What is going to happen with this enormous weight of China in this field of global finance? How will the G20 be able to deal in a multilateral fashion with the problem of indebtedness of the poorest countries, which is so much relying on one single big lender like China? I mean, there is a political problem. There is a lot of asymmetry. If these debts are pardoned, if these debts are cancelled, well, China will, in a way, gain an enormous political credit. And how can the international community can deal with this issue? Should the multilateral lending step in and substitute the bilateral one, or what should we do? How the G20 should work? And this is important, especially for next year, obviously. Hello?
All right, Franco. Yeah, this is a very ongoing issue, and it's very, very important issue to be discussed. But you know, China certainly is the large creditor, well, in terms of the scale, but China is also a new creditor. So this is something, you know, when we talk about the Chinese role in this debt relief, and because of this Chinese new player in this field, and there are many, you know, issues which are open to discuss. So which is probably the good thing, because, you know, it is open. And secondly, yeah, next year, I think there are a lot of issues, you know, attached to this. And secondly, I think China actually is really willing to join multilateral approach. Well, the G20, for example, basically this year, China, you know, committed to G20 to join this, you know, joint action. And I think China is going to contribute through G20 consensus and initiative. And another one is, I think, because China is new, and China really want to learn, you know, practice, the best practice of the, you know, the creditors, the mature creditors. And one thing I think is very important for China is the, you know, multilateral framework standard. Really, we need this, you know, standard, and we can follow. And this is something really, yeah, it's going on. The IMF actually, you know, is going to do this on a multilateral basis, but there are many other players to jump in. And of course, private sector, this is a big issue, because, you know, it's not many are willing to join, but it's very critical part. So this is my initial response. This is really ongoing issue, and I hope we have more discussions in later time. Yeah.
Thank you. Any other considerations on the topic? Otherwise, we give back the floor to the managers of this webinar. Yes?
I will add, Franco, that this is a very important issue, really. But it belongs in a bigger field. We need to have a comprehensive method to deal with this. And one part is Paris Club procedures, but others are, for example, loans. The countries not only are indebted with bondholders, also with loans, and loans are set aside. So we need to put everything all together. And this is not only China or Russia or big bilateral creditors, it's more than that. So I think you're bringing to the table a very important issue. And I hope that G20 Italy might bring some solution to it.
Yeah, let's hope. There's also a problem of transparency, because as far as I understand, for instance, the World Bank has been collecting data and has been conducting simulations, but even the World Bank is insufficiently informed on all the details of these amounts of money going around. So we have to bring
right. Unfortunately, the task force has published one very interesting policy brief on debt transparency on these issues. But you're right.
Okay, so I think this part of the webinar is now concluded in time, and I leave the floor to the managers of the webinar. Thank you.
Well, thank you so much, Franco. Thank you for the panelists for their informative discussion. Now we will actually go to the final panel of this webinar, which will be moderated by Dr. Nabil, the lead co-chair of this task force. And the panelists are going to be Franco Bruni again, and Catherine Princeman, a senior researcher at German Development Institute, and Dream Ayadi, the founder and president of Euro-Mediterranean Economics Association. So I will give the floor to Dr. Nabil right now to moderate this panel.
Yes.
Thank you, Amal. Welcome back to all of you. Last panel discussion for today and for the Task Force 8, it's going to be international coordination to fight COVID-19. Actually, we are getting back to the main subject for the whole year, COVID-19 and what caused by this virus. What we see this year in 2020 that never been seen, at least in the last 100 years ago, and whether we have to deal with it. We see a lot of things that never been so in any countries, and I think the level of coordination was a very good advantage for all of us, to the world, for dealing with this COVID-19 virus. I think if this virus happened years ago, we might see different result. Even though we have still very tragic outcome from this COVID-19, we already reached almost 1 million deaths, more than 30 million infected by this virus, and media talk about the second wave in some countries. Unfortunately, we need to deal with this in the coming winter in different ways. And we already have a good experience in the last few months dealing with this virus. So today we're going to discuss the international coordination to deal with to fight COVID-19 overall, and hopefully will benefit from this coordination to avoid any future such viruses. So I will introduce first Catherine as a senior researcher, German Development Institute, to start for almost less than 10 minutes. We have 35 minutes to go for this discussion. So please, Catherine, if you have 10 minutes, and then we'll move to the second panelist. Thank you.
Okay, thank you very much. I have sent, okay, thank you very much. Thank you very much for the invitation. My presentation is COVID-19 crisis. How should the G20 contribute to close the financing gap in low-income countries? This is not the topic of our policy brief, which was the COVID-19 crisis. How should the G20 support heavily indebted low-income countries? Because I should have gone a bit beyond our policy brief and a bit broader topic. Could you go to the next slide, please? First, I will provide an overview. In the first part, I will outline the impact of the COVID-19 crisis on development finance. In the second part, I will outline the challenges of the G20 development finance. And in the third part, I will give some, or will provide some core demands to G20 countries. The next, please. The impact of the COVID-19 crisis on development finance. The COVID-19 crisis hits the low-income countries in times of an inadequate development finance flows and increasing debt levels. First, we have internal funding flows decrease, for foremost tax revenues. Second, external private funding decrease, in particular FDI and remittances. Third, export earnings in developing countries decline significantly, and developing countries' debt will further increase. So there will be a recession, or already has been a recession in many developing countries. Here you see one graph, the change in net inflows relative to the pre-crisis year. And we compare here the global financial crisis in 2008 with the COVID-19 crisis in 2020. These are data from the OECD. On the vertical axis, you see the change is a percentage change relative to the previous year. And on the horizontal axis, you see remittances, FDI, portfolio investment, and other investments. And here you can see that remittances and FDI declined significantly in the COVID-19 crisis, much more than the global financial crisis. Here, remittances and FDI in the percentage change relative to the previous year was positive and not negative. But in both crises, portfolio investment and other investment decreased substantially. However, remittances and FDI are more important for low-income countries than portfolio investment and other investments due to their less developed financial markets. So next, please. We see here in this graph that according to data of the UNCTAD, low-income country for developing countries, the total SDG financing gap, the annual total SDG financing gap is estimated to be already 2.5 trillion US dollar. So on the one hand, we have a decline in development finance flows internally and externally due to the COVID-19 crisis. And on the other hand, we also had before the crisis a large SDG financing gap. The next, please. So LICs are in urgent need for financial assistance. The international community has a key role in providing financial assistance. And in particular, stronger countries such as the G20 countries have to take on a role in this. And the World Bank president said, for example, without immediate financial support, the progress that these countries have made in their development over the past decade will be lost. So it is urgent that G20 countries take on a frontrunner role in financing low-income countries. The next, please. The challenges of the G20 development finance, I address 3 challenges here. These are the low official development assistance. There should be an increase in climate finance and the high debt in these countries. The next, please. As regards the official development assistance, the countries have confirmed to reach the 0.7 percentage target until 2030, like the EU. But currently only 5 members of the Development Assistance Committee of the OECD, DAC, have achieved this target: Denmark, Luxembourg, Norway, Sweden, and UK. And on average, the DAC members have provided only 0.332% of GNI. Next, please. And in addition, it would be important that also emerging economies take on a responsibility here. Only some emerging markets have received the have achieved or superseded the 0.7 percentage targets. These are Saudi Arabia, Qatar, Turkey, and the United Arab Emirates. But the challenge is that many emerging economies there's no commitment to increase their development assistance. And also there are reporting difficulties because definitions and categories are different. The next, please. In addition, we have the climate finance targets has not been achieved, or at least we have the most current data are from the OECD, and from 2017, these are the most current data available. They have committed to provide 100 billion US dollar annually until 2020, and they have achieved in 2017 the official side 54 billion and the private side 14 billion, and also there are some export credits of 2 billion. But nevertheless, the next slide, please. There is a problem that we don't know how the division of flows between public and private actor, how to split the sum between public and private actors. And it is not clear whether climate finance is additional to ODA commitments. So next, please. So climate finance is also a problem. In addition to that, as we have outlined in our policy brief, the COVID-19 crisis will further deteriorate the debt situation in developing countries. Currently, more than 50% of LICs are in debt distress or are at high risk of debt distress, according to IMF and World Bank debt sustainability analysis. The next slide, please. Therefore, we have 6 core demands to G20 countries. They should commit to specify appointments regarding the intermediate targets for the 0.7 goal before 2030. They should define a time frame for providing climate finance after 2020. They should offer a longer debt moratorium for LICs, so 1 to 3 years. The G20 finance ministers have already committed, I think yesterday or the day before, to prolong the debt moratorium by another 6 months, but this might not be enough. The G20 countries should replenish the IMF's Catastrophe Containment and Relief Trust. This is an instrument to provide debt relief for debt services for low-income countries, but this fund has, of course, to be replenished. And the G20 countries should provide a comprehensive debt relief for highly indebted low-income countries. And the G20 countries should discuss a Marshall Plan for Africa. The next slide, please. A Marshall Plan for developing countries or for low-income countries during and in the aftermath of the COVID-19 crisis would be a good economic stimulus for developing countries. It would provide immediate liquidity support, and IFIs and industrialized countries such as the G20 should take on a frontrunner role. The Marshall Plan could include a debt relief to developing countries or to at least highly indebted low-income countries. The money which is provided and also under the debt relief, this should support social and the health systems, and there should be some earmarking of financial support. And the Marshall Plan should be a green Marshall Plan. There should be investments in green industries and in greening infrastructure, and also they should offer financial resources to developing countries for climate mitigation and adaptation. So if you go please to the slide before, no, one before, yeah. So there are several demands to G20 countries. I have not further elaborated on, for example, the debt relief issue, but I could do it during the discussion. Thank you very much.
Thank you, Catherine. Now we are going to introduce Breem Ayadi, the founder and president of Euro-Mediterranean Economic Association. Please, 10 minutes, because we have another discussions for another 10 minutes, and then we will close. The floor is yours, Reem.
Good afternoon, everybody. Do you hear me?
Yes,
go ahead.
Yes, we do.
Yeah. Thank you very much for this, for organizing this webinar. So my remarks will be really aligned with the latest issue, also linked to my paper on debt transparency in low and middle income countries, and also in line with the whole debate over the past months, but also specifically over the last couple of weeks. At the eve of the IMF and World Bank Group annual meetings, which is really to find a way, collaborative way, including the private creditors, to collaborate further and to coordinate their actions with the IMF, the World Bank, and others, also Paris Club, to in fact solve the problem of this huge debt accumulation in the middle and low income countries, specifically in Africa, and obviously how to move into further debt transparency to better assess the magnitude of the problem. This is what my remarks will be covering. So first of all, I will tackle the increasing sovereign debt in the middle and low income countries, and the current efforts of the international community to respond collectively within this global pandemic. And two, we'll share with you the proposals of the policy paper we did for this task force in Riyadh to foster coordination and collaboration with private creditors via this debt transparency platform. So the COVID-19 pandemic, as you all know, has caused widespread concern about debt unsustainability in both developed and emerging economies. Africa has been one of the key targets, and we've seen some of the countries that are almost nearing default and restructuring, like the case of Zambia last week. Also, a recent call by the IMF, which was published a couple of weeks ago, it's really alarming, or putting some alarming figures on the debt ratios projections, which are rising by more than 20% in advanced economies, 10% in emerging markets, and 7% in low-income countries. It's huge when we know that the debt level already, when we started the pandemic, were quite high. So historically high since 2019. So if we look at the advanced economy, they have the capacity to borrow because they have low interest rates and much lower risk premium. But then emerging markets and low-income countries face much tighter limits on their ability to borrow further, and also the borrowing costs are extremely high because also of a very high risk premium. Now, the IMF is pushing very much, and quite surprisingly actually, for more reforms on international debt architecture. Really making very specific requests, or I would say recommendations, in relation with more debt relief for low and middle income countries, but also to strengthen further some contractual obligations via the extension of collective action clause to liabilities that are not necessarily issued as a bond. So as a bond, which is all the liabilities that are non-bonded debt. So this means that these clauses will lower the debt payment, or eventually automatically suspend certain debt services, such as, for example, very extreme events, natural catastrophes, or large economic shocks that, like the ones we are seeing today. So this is also good to explore with the private creditors whether they are willing to go into this direction, specifically with respect to countries that are already accessing funds in the market. Now, the third point which the IMF put forward is to enhance debt transparency to facilitate restructuring and resolution decisions and action. This is quite interesting as well, because we know since many years the IMF is lending to some low and income countries, and then the debt transparency most probably was not on the top of the agendas back then. Also, surprisingly, but it's a very fortunate development, that the World Bank Group has published historical debt data with unprecedented level of granularity. And this publication was issued last week. But it is very much welcomed and will support also the research community to further examine this debt accumulation risks in the global economy and welfares in those countries. Now, we know very well that the G20 has initiated these debt restructuring initiatives under the G20 Debt Service Suspension Initiative, which has worked pretty well Of course, there have been some calls to move it forward. I mean, to extend it, and there has been already, as Catherine mentioned, an extension of 6 months. Perhaps the 6 months will not be sufficient, but then extending it to up to 3 years, it's a decision to be very carefully studied, because some countries most probably will be used not to pay their debt. Now, also, the IMF and the World Bank Group have both called to further participation of the private creditors in the debt relief effort. So those private creditors, obviously, for reasons that are obvious, are quite reluctant to participate massively in this effort. And I would like also to remind that the international or the Institute of International Finance has committed itself to voluntary principles for debt transparency since a year ago. But then what has been done in that respect, probably this needs to be looked at. So whether the private creditors, they have pushed for further transparency on the issuance that they have made. And at the same time, obviously, this would give much more incentives for them to know what are the implications for any debt relief efforts going forward. Now, for all this complex matter of sovereign debt architecture, transparency is in the heart and should have been really dealt with several years ago to move forward into much more data, specifically on the new issuance, and also allow everybody from the public, either countries, but also academics and civil society organizations, to really access this data to enhance, in reality, debt accountability generally. So our proposal, and this is something which in reality is in the heart of all this debate, is to implement a public global mechanism for recording old and new sovereign debt issuance to boost global debt transparency. Now, what has been done so far is not sufficient. And I think what needs to be done now with all what we are seeing in terms of the debt relief calls and, spending much more or borrowing much more to face the pandemic, is to have an independent, open access, real-time debt transparency platform that will allow proper monitoring of what is going on the debt side. This will increase, in fact, accountability, but also will reduce the asymmetries of information in the market. And this will also probably give more incentives to the private creditors to, in fact, have much more probably, or give more information to the market on what is really the real prevalence of this debt, specifically in the countries that are low income and middle income. Now, we are even going further in our discussion, or at least in our thinking, is to ensure that whatever registered new debt issuance should be also a condition for non-subordination in the event of default and restructuring. So means if the new issues are not registered, then most probably in the case of default, whoever is not sharing the information will have to be subordinated, and most probably the recovery rates would be much lower. So this is pretty much the idea, and I think there is a large debate now between the different stakeholders to to coordinate their efforts to find a mechanism that will allow more transparency and more contribution from the private sector onto this whole debate of debt architecture, because equally to China, I mean, I didn't get into the case of China because the previous panel discussed it. The private creditors are quite an important pillar nowadays in this specific market, particularly in low income and middle income countries. Thank you.
Thank you, Reem. Just one comment on this issue. I think we have already the platforms or the register that can be used for such proposal for this policy. As we mentioned today in the LEI side, I think LEI could be a very good mechanism to restructure the debts and make it available to increase the transparency and make sure that private and government debts can be seen by everyone, and also we can assist based on this information the risk that associated with such. Thank you, Reem. Now we move to Franco. Back, thank you again. He's the Vice President, Institute for International Political Studies. So, Franco, the floor is yours. Thank you.
Well, yes, the COVID crisis reinforces, as it is obvious, the many arguments in favor of a strong resumption of global multilateral cooperation in all fields. This is the message, the main message we get from COVID as far as we are concerned. And the G20 is key in these efforts, and the Arab, the Italian, and the Indian G20s of these years must register increasing successes in this cooperation. If this is not the case, I think the condition of life in all parts of the world will severely deteriorate in the near future. With Jose Siaba Zerate, we have written a policy brief for this workforce on a rather narrow but important topic of multilateral collaboration, which is central bank policies and strategies. We urge central banks, upon invitation and stimulus of the G20, to move towards a more transparent, strict, explicit, announced coordination that would also tie their hands with clear commitments towards the world, and therefore increase their credibility, which is dangerously diminishing, I fear. Central banks must get out of the trap, the formal trap, because the substance of the trap, in a way, has been won. But there's a formal trap constituted by their statutory concentration on national interest, and there's no such thing as a national interest in financially super-connected global world. In our brief, we discuss several central bank policies for the various phases of the pandemic crisis and for the time when COVID will be finally out of sight. We discuss the provision of liquidity for both advanced and less developed countries. We discuss the complex issue of coordinating monetary and fiscal policies to support economic activities during the crisis, the coordination between monetary and fiscal policies. We devote special attention to emerging and less developed countries. We discuss the fact that gradually central banks must realize officially that their main objective is perhaps less price stability and more financial stability. We insist that a period will come when the enormous amount of debts, private and public, that are now keeping accumulating also because of the COVID crisis, this amount of debt will become the major problem of the world from an economic point of view, especially when interest rates will have to be normalized. A strategy to gradually cope with this problem must be officially and transparently planned much in advance. We propose special meetings organized by the IMF and BIS under the auspices of the G20, and recalling what we think has been a very positive initiative, short-lived, unfortunately not very positive in its design, which was the IMF 2006 multilateral consultation meetings. These efforts should be taken again to work on coordination, normalization of policies, financial stability monitoring, planning debt reductions, with a lot of transparency and official announcements. Finally, let me conclude with this. In our brief, we do not emphasize one aspect of monetary policy strategies that will have to be discussed in a coordinated fashion and by the G20. And these are the monetary strategies to support climate finance, climate policies, and anti-pollution policies. In these matters, there are clearly social benefits that are not internalized by banks and financial markets. And central banks have several instruments to generate the right incentives to act. The European Central Bank in particular is working hard to prepare a series of proposals of actions to move in this direction. However, again, without an intense global coordination, these central bank policies taken in isolation, looking only at national interest or in the interest of a specific currency area, risk to be useless and ineffective, because we are dealing with global issues and we must deal in a global way with global issues. Let's hope to move on these themes also with the G20 2021. Thank you.
Thank you, Franco, and thank you, Catherine. Thank you, Reem. And I think by hearing from Franco, we finish this very important task force. And I think it was that if there is a one magic word that can be used for this task force in particular is the coordination to make everything function. So many different subjects, but somehow it's linked to each other. And as all of you mentioned it in a way or another, without having coordination, close coordination on G20 level and maybe beyond G20 level, those subjects will not be basically addressed in the near future. Also, another magic word in this task force is that transparency. I think also we need such transparency. The last word that I really want to emphasize in this task force, I think, and can play a very big role in make it succeed, stories in different areas like digitalization, digital currency, fintech, big tech companies, is to have a database around the world that can be shared between different countries, different institutions around the world, to make this huge agenda that is really revolving over time, as we have artificial intelligence, Internet of Things, blockchain, all these things that coming to us, that we need to deal with it as a government, we need to deal with it as a user, we need to deal with it as a business. So I think, yes, the task force, which is a international financial architects, need such coordination and need all these things. Thank you, all of you. And I think by doing so, we close this full year. And I really appreciate all the authors that help us as a leading chair for this task force to come up with those 8 policy briefs. And the good thing is that major of those subjects is being already will be escalated in and will be show in our communique to the leader, hopefully. Again, thank you all of us, and I will hand it to my assistant, Amal. Thank you, Amal.
Thank you so much, Nabil, for moderating this panel. Thank you all for being part of this webinar, the very final webinar of our task force. We're so grateful to welcome Pier Carlo Badon, the Vice President of Institute Apri Internazionale from Italy, to give an Italian perspective. So we hope that he's on air with us right now. I think we lost him. Yes.
We still have the technical problems.
Okay, so I think he's now no longer here online. So we will give the closing remarks. So I'll give the floor to Dr. Fahad Al-Turki, the chair of T20 Saudi, to give his closing remark. Dr. Fahad?
Thank you. Oh yeah, Keith, of course. Thank you very much. It's been a pleasure to connect with everybody today. I've been attending all these webinars since September 17th, one webinar per task force. And I can tell you, while it's been hard to close these task forces while not meeting you in person, it gives me a great pleasure to see the hard work of the task forces that went through the whole year, producing very important and relevant research and unbiased research-based recommendations or policy recommendations. We've been busy preparing the webinars and the summit season. We look forward to the closing and also handing the recommendations to the G20 ahead of the Leaders Summit in mid-November. I would like to take this opportunity to thank my colleague, Nabil, who's a dear friend, for accepting this huge assignment on taking the lead on this task force. It's very relevant task force on the subject that is close to my heart, the financial architecture. I've been an economist most of my career, and this is an important topic that is, I think, produced mostly relevant or all relevant recommendations that we adopted in our communique, including, and I would refer to the main points that were highlighted today, especially by the opening remark by my colleague Nabil, the importance of the coordination between fiscal and monetary policy, and the need to learn from previous crises on addressing the challenges created by COVID-19. And I think many of the panels today, the panelists elaborated and detailed such need. I like many of the comments and the discussion related to the debt relief, especially during this period of time. We heard the last panel talking about debt relief and the need to provide immediate liquidity, especially for low-income countries. We would like to also, I would like to also highlight one of the important points that was highlighted during today as well as in the policy briefs, which is the need to reform and expand the global financial safety net and increase resilience to shocks. And I think during this time, this is as important as ever before, a policy recommendation that will come from the T20. And as we move into the digital world, and I think this is a testimony of us moving into the digital world, I think there is a greater need to develop a comprehensive agenda to increase the resilience of the financial system as it incorporates digital money and digital financial tools. I think many of our regulators, especially not only in the G20 countries, but also outside, they're behind the curve on addressing the digital currency and the digital financial tools. There was also one of the main recommendations or the main points that I picked up from today is to consider the digital currencies to resolve trade frictions in less developed countries. And also initiate, and this is one of our recommendations I highlighted actually in one of the T20 official statements previously during the year, which is initiate a G20 digital money and finance working group. And we hope that this will be adopted recommendations moving into the Italian presidency. I see Pier Carlo is joining us. Hopefully, the voice can work. If so, I will give him the mic, and then I will take a few minutes to close after him.
Hello, good afternoon. Can you hear me?
Yeah. Yes, we can.
Very good. Apologies for delay in appearing on the screen. There was some misunderstanding about the time given the time zones, but I was able to listen to the final interventions of this very important seminar. And so allow me to spend a few minutes looking at the issues that you have raised with the perspective of the next G20 presidency coming in, headed by Italy, but also with a new environment where the issue of cooperation and collaboration are more relevant than ever. Indeed, you have discussed a lot about the financial architecture implications. Now, let me try to add a few remarks about the following issue. What can the financial architecture structure tell us in terms of resilience and in terms of ability to respond to the great shock of our time, that is the COVID-19 shock, which is, by the way, the textbook case for international cooperation. Why is this? Well, think of the following aspects. A pandemic is by definition a public bad. It ignores borders, it ignores specific national reactions. It requires the definition of an implementation of a collective reaction, which requires itself a link between international collaboration and domestic policies and politics. I can expand on this theme by recalling very briefly what has been so far the Italian experience in dealing with this crisis and the implications for financial response. The COVID crisis, as you know, produced the need to lock down economic activity in many countries around the world. This has been done with different successful rates, but in general, the response has been very painful for the economic activity, and a big trade-off has emerged in terms of protecting healthcare and protecting the economy. And we are still very much in that dilemma. Although my point is twofold from this point of view. First of all, that financial safety nets are more than ever needed to deal with unprecedented shocks such as the one we are witnessing today. But also at the same time, they are needed to be implemented on a cross-national basis, exactly because of the collective action problem implicit in a COVID shock. The fact that there is a public bad which requires, let me say once again, a collective response. What can we gauge from the point of view of national experiences, especially in Europe, which is a highly integrated region, and therefore a region where the benefits of integration can be exploited well, but also the cost of integration can be very high if the societies are not ready to introduce more resilience in their networks. Well, the financial safety net response has been huge in Europe and in my country, certainly, to the extent that the existing institutional frameworks in terms of monetary policy and in terms of fiscal policy coordination have been dramatically changed to deal with the collective action problem posed by COVID. We needed, and we badly need, a financial safety net response in terms of immediate response to the liquidity shock that the crisis has generated. And we also need a liquidity response over the longer term to reboost growth and rebuild growth, not only to bring it where it was, but also to rebuild the society to be more resilient and more responsive to healthcare shocks such as the one we've witnessed. Has this worked so far? In Europe, this has worked thanks to the fact that existing policy frameworks are working in a totally new fashion. The European Central Bank has rightly so poured a huge amount of liquidity in the system exactly to provide an overall financial safety net for the region, for the European region. By so doing, let me say that this has contributed to global stability and stabilization. It has provided a crisis-driven financial safety net, which has allowed to avoid further reduction in GDP activity, which has averaged about less than 10%, negative 10% in many countries in Europe and also elsewhere. So first lesson from the crisis, liquidity safety nets can be very flexible in responding to the crisis. And this requires that existing rules have to be changed and reconsidered. Indeed, as we look forward, one of the big questions coming from the European monetary policy environment will be to what extent monetary policy and therefore financial support will be back to more normal frameworks, or should we rethink the frameworks? The need to rethink the framework is even more compelling possibly when we go to fiscal policy. Because as you certainly know, the Stability and Growth Pact fiscal policy framework in Europe has been lifted, suspended, so that governments can use their deficit to support the economy and to relieve the economy from the negative shock which we've just witnessed. Again, this is necessary, and I welcome the fact that the European institutions have decided to go this way, not only in terms of lifting existing rules, but pouring new instruments and new frameworks in the European economic policy context. This has allowed so far to expect a year of deep recession, the current one, but also a strong bounce back, strong spring back next year, possibly bringing European growth rates back to the pre-COVID levels in a relatively short period of time. However, this is probably not enough. We will need structural policies to boost productivity and growth mechanism, and we can do this by looking at a different model of the economy, more sustainable in terms of environment, in terms of social safety net, in terms of absorbing new digital technologies, much along the line of what has been said just before my remarks. So once again, we are in a situation in which a big crisis is a big challenge, but also a big opportunity. This is not to say that everything is working well. By all means, this is not the case. We still need to coordinate between countries. We still need to coordinate between institutions. We still need to coordinate more globally. I think that if there is a lesson, once again, that all the world should receive from this crisis, and the G20 should make an assessment of the lessons from the COVID crisis, is that we are truly in a global situation which requires a global approach to coordination. I'm saying this, which may sound obvious to all of us, but it is not, because we have seen even before the COVID crisis tendencies to go national, to go individual, to go bilateral rather than to go global, rather to go multilateral, and to strengthen multilateral institutions. So once again, let me say that this is the line that Italy will develop further in the G20 presidency which is approaching. Let me also say that I would like to thank very much our Saudi friends and colleagues for organizing such an interesting seminar. And I hope that we can already meet again in Italy for the meetings of the next year's G20. Thank you again for your attention.
Thank you, Pierre. It's a great pleasure to have you with us and hear what the forward plan for the priorities of this task force moving into Italy. We're also lucky to have Franco Bruni as well with us today, and we look forward to working together with our Italian colleagues to make sure that there is a smooth handover on different priorities. I cannot agree with you more on the global challenge require global collaboration as well as strengthening multilateralism. Of course, we entered this shock or this pandemic on a weaker note for the multilateralism role and the tendency toward protectionism that hurt trade and other economic gains of globalizations. The good thing is the initial shock is behind us during March, April, where we've seen on the peak of the impact of the pandemic. Moving forward, many countries, especially in Europe now, are gearing up for a second wave of COVID-19, and as we transition from T20 Saudi Arabia to T20 Italy in December, probably these issues are going to be tackled and will be focused among our think tank community. The great thing that we have seen so far when we talk with the G20 leaders is because of the pandemic, because of the huge level of uncertainty, there is a greater dependency on the think tank community to deliver practical, unbiased, research-based policy recommendations. Throughout my meetings with the working groups and with the Sherpas of the G20, I've seen and I felt that there is dependency on us and trust on the think tank community to provide the recommendations. And we will deliver with our communique, which summarizes all the recommendations that were highlighted in this task force and the other 10 task forces. I would like, on behalf of the T20 Secretariat, to thank everybody who participated and contributed to the valuable recommendations during this year, and in particular for this task force on the financial architecture. And a special thank to my colleague Nabil Al-Mubarak, as well as the coordinator Amal Al-Rashid, for bringing us together every time during the year. Of course, a special thank for our international co-chairs, who without them, we would not have the quality of the policy briefs, which all went through a rigorous review process, more so than any other well-respected journals. So very proud of the output. We see it also in the reaction in our social media platform, as well as from a political side, the decision maker, the appetite to receive our recommendations is higher than ever before. I would like to also thank our co-host for this webinar and also for other summit season webinars that we hosted so far. It's a great opportunity to share the T20 summit activity. which I would say this is the first time in all T20s that a T20 shares activities of a summit activity, I should say. We are in Saudi, we are open and inclusive for a future of sustainability and prosperity, inshallah. And I would like to also convey a special thank to especially our leading institutions, CAPSARC and KF-CRIS, for their continuous support through the year in organizing the events as well as financing the events, and especially during the COVID-19 or the difficult time of COVID-19. They brought us together. More than 500 think tanks participated. Around 700 authors wrote our policy briefs, coming from around 80 countries. So it is indeed, the T20 is an open and inclusive platform for all opinions and all ideas. Thank you for your contribution today. It's been a great webinar. So far, I enjoyed all the webinars, all the previous ones, and I look forward to the upcoming ones. We will have our Task Force 9 on Tuesday, October 20th, at the same time, which is Migration and Young Society. And then on next week, Thursday, we will have our Task Force 10 on Sustainable Resources. And then the following week, we will have our last but the most important task force on COVID-19, multidisciplinary approach to complex problems. Before we close our summit season on October 30th and November 1st, which is the finale, if you wish, of our summit season. I invite you all to participate in all the webinars and welcome all your feedback and encourage everybody to continue the process throughout the Saudi presidency and into the Italian presidency. Thank you very much and have a great day. And we'll see you on Tuesday, inshallah.
Thank you all.
Bye.
Thank you, Fahad. Looking forward to collaborate with you in Italy.
Thank you. Thank you again for your hospitality.